Okay, good morning. How was your weekend? It's good. Okay, I have an announcement to make before we go into chapter 3. Just a little bit of chapter 3 left, and then we'll go over the new chapter today. Since we're a little bit behind of schedule, I'm about one class behind the schedule, so I'm about to push back midterm for a week. Okay, so I'll be having midterm March 4th. I wanted you to have enough time to do review for chapter 4. So we're covering chapter 4 this week, and then midterm will be on March 4th. It's same Monday, same time, same exam structure, just a week later. Okay, so we just finished chapter 3 last week, and this week we're finishing up chapter 4. I want you to have a whole week to do some reviews for all 4 chapters. So next week the lecture will be on chapter 5, and also I'll do a brief review for midterm. Okay, so you will have midterm the following week. Instead of the last week of February, it will be March 4th. Okay, is this a little better in terms of reading, capturing everything? I know there's a lot of other courses you have midterms at the same time as well. So I want to give you a little bit more time, and want you to make sure that the first 4 chapters you really understand before we move on to chapter 5 and 6. Okay? All right, now we have a little bit of chapter 3 left, just this slide basically, but really the topic continues in chapter 4. So I'll be doing a lot more comprehensive introduction in terms of how to actually do statements from adjust to trial balance in chapter 4. Okay, but last week the main part here we learned was how to get to the 3rd column here. Remember, adjusted trial balance. So how many adjusting entries did we cover last week? How many categories? Adjustments. We have unearned revenues, right? If the corporation collects cash in advance, later on that turns into actual service revenue. This is one type, right? So the opposite of this would be accrued revenues. Remember, providing service first and then receiving cash. Okay, so these are the 2 types of revenues adjustments. We also have prepaid expenses adjustments. Right, if the corporation paid rental or insurance benefit in advance for the next 6 months, and then we want to understand what are the parts that we need to adjust, the parts that are no longer in force, no longer there, that we used up already. Okay, so as opposed to prepaid expenses, we also have accrued expenses. Remember, the term accrued means accumulated. Okay, so accrued expenses, which basically is the opposite of prepaid expenses. We are using a certain type of benefit or, for example, employees worked for your company, you haven't actually paid a salary paycheck, then the deferred expenses that you're actually paying later is called accrued expenses. So when it comes to the end of the period, we want to make adjustments to make sure that those liability, salary expense, salary payable, or rent expense, let's say rent payable, if it's the opposite of prepaid expenses, we want to make sure liability is there. We are representing the benefit that company readily received, but you have not paid cash to other corporations or your employees that you hired. Okay, there's another type here. We have accumulated depreciation and at the same time depreciation expense. Whenever a company has long-term assets, we always want to measure the part of the assets, the value that is no longer there, that we deduct. Okay, so as time goes by, we represent that long-term assets value will no longer be the same as the time point when we purchase it in. So the same type of furniture, same equipment, machinery, after using it for 10 years, the value has to be deducted to a certain point. And we do this by spreading out the cost along the year. So every single month, we'll be deducting the value of long-term assets. This is what we call depreciation. Okay, so accumulated depreciation is always tied to a certain type of long-term asset. You may see furniture, original historical cost, the money that you use to purchase. Then you see accumulated depreciation representing the part of the value that is no longer there. Okay, so after the adjustments, the middle column here basically summarizes all the several entries that we need to make the adjustments before the end of the period. And then we have the right-hand side, the adjusted trial balance. Okay, Okay, so some of the accounts that you don't see adjustments next to it, you basically just copy and paste the same dollar amount to the right-hand side column, the adjusted balance. Okay, we only go to change some of the accounts that we actually have adjustments tied to it. So after the adjustments, this right-hand side column really is the final number that you will see on financial statements. Okay, so when we do financial statements, remember we always start from income statement. Okay, so who can tell me what goes into income statement? Generally speaking, what goes into income statement? What are the categories in the statement? Revenues is the first line always, and then what's next? All the expenses. And the goal is to get to what? Net income or net loss, the profitability of the business. And only for that season, only for the month, well, only for the year. Okay, so if we look at the right-hand side column here, adjusted trial balance, we will only be using the bottom few lines here for income statement. So really, all the categories that relates to revenue, and not the ones that are called revenues. Remember, an earned revenue is a liability account. Okay, so it's the real revenues account, service revenue, sales revenue will go into income statement. Also, all the expenses. And again, prepaid expense is an exception. Prepaid expense is a type of asset. Okay, but all the other expenses here is considered part of income statement. So the bottom ones here, after dividends, typically we will list all the revenues, all the expenses, and this will be the part of the number that can be exactly copy-paste to the official format of income statement. So income statement, all the statements, there's an official format to structure it in. We usually start from, again, income statement, revenues, and expenses. Okay, so this internal document is only used within the business, then these numbers will be copied and pasted to the official structure of income statement. So after we have net income or net loss, remember the second statement would be, what is the second statement? After income statement, we have net income amount. Balance sheet is the end. What's in the middle? Retained earnings, statement of retained earnings. So once we have net income and net loss, then we add that to the beginning retained earnings, which is 3,200 here. Remember, retained earnings, the definition here is the earnings kept all along the years. Okay, so it's the earnings accumulated starting from day one of the business operation up to now. So the bottom one here is the new earnings that we earned in this season. We add that to the beginning earnings, 3,200, and subtract dividends, which is the part of the earnings that you give away to shareholders if the company declares it. Okay, so if you see dividends, that means this year they're doing actually pretty well. They want to reward shareholders by giving away a portion of their earnings. So you will use whatever is the net income represented here, add to 3,200 minus 1,000 to get to the final balance of retained earnings for this season. Okay, the 3,200 was the beginning retained earnings before all the activities happened. After all the activities, we add a new net income to the beginning retained earnings, subtract dividends to figure out the final balance for retained earnings for this season. Okay, so after the two statements, then the upper accounts, all of the other asset account, liability, stockholders' equity, specifically common stock, and the new balance from retained earnings statement together forms balance sheet. Okay, so remember, balance sheet here mirrors the entire accounting equation. You will see balance sheet the left-hand side with assets, right-hand side with liability account and equity account. Equity here breaks down to common stock and retained earnings. Remember, common stock is externally raised capital. Retained earnings relates to all the internal activities, sales or services that company had earlier to support the business operations. Okay, so statement of retained earnings is only looking at retained earnings account changes. Income statement is even more narrow. It's only looking at profit, net income, or net loss. But all of these accounts are part of retained earnings. So once you do income statement, net income will be transferred to retained earnings. Retained earnings final balance will be transferred to balance sheet under retained earnings equity section. Right? So all the information really from the first statement is later on tied to the very last statement, balance sheet. Okay, balance sheet gives you the most comprehensive view of all the categories, all the accounts, all the activities that's happening in a particular time, on a particular day. Okay, so this is a summary of Chapter 3 at the end. What do we do with adjusted trial balance? It's really the numbers that are ready for financial statements. Okay. In Chapter 4, I'm going to be introducing the complete worksheet. So adjusted trial balance, what you just see, we have 3 columns. Some of the companies really just use 3 columns. That's there in some of the business. They just stop at the 3rd column, which means that number is ready, and then they put the number to the complete financial statements. Other companies may decide to add another 2 column, income statement column and balance sheet column. Today we'll be doing an in-class exercise on this. Basically, it's the same information. They're just copying the income statement information to income statement column, and then balance sheet information to balance sheet column. There's just additional columns. Some companies want to keep the entire worksheet very complete before they get to financial statements, making sure debit equal credit. Okay, so today we'll be introducing a complete worksheet, which really you already know the first 3 columns. The unadjusted, the adjustments, the adjusted. We're just adding 2 more columns, income statement and balance sheet. Okay, so the purpose here again is still to support the business to do a financial statements that has the accurate numbers, that has the appropriate numbers that relates to all the transactions that happen within a certain period of time. Okay, so let's start from the accounting cycle. This gives you a broad picture of what we're trying to do in all these, the past few chapters that we talked about, starting from the first all the way to now. Okay, for each and every accounting cycle, we start from the beginning balance of the accounts. So meaning that earlier, last year, at the end of last year, when we do last year's financial statements, you will have, let's say, cash balance $1,000. Then in the beginning of this year, January 1st, 2013, we will start from the cash balance $1,000, and then we add to it, or subtract it. Okay, same for accounts receivable. Last year's accounts receivable, if it is, let's say, $2,000, that represents future cash receipt $2,000, that will be used for this year's beginning balance, $2,000. And then we add to that, or we subtract that. Okay, so last year ends 2012, December 31st, whatever was the balance there for all the balance sheet accounts, we'll be transferring that dollar amount and use that as this year's beginning balance to start out the year. Okay, so then as transaction happens, as we purchase things, as we sell things, corporations will analyze and journalize the new transactions. So this is the second box. We start from the beginning balance from last year. We capture new transactions. We post these transactions to T accounts as they happen. So this is this part of the transaction, the process that we covered in Chapter 2. Okay, we journalize new transactions that happened in 2013, post them to T accounts. Okay, now when it reaches almost, if the company is trying to do monthly statement, when it reaches almost January 31st, we try to compute the unadjusted balance based on all the journal transaction that happens. Okay, so that would be the worksheet, the first column, unadjusted trial balance. So in Chapter 3, introduced to you was the adjusting entries. When it reaches the very last day, January 31st, adjusting entries need to be made. All of the 5 categories that we covered last week, all the adjustments that we want to bring up the accounts up to its current status. Okay, so journal transactions, post them to T accounts. When it's close to the end of the period, we summarize an unadjusted trial balance, and then figure out whether the 5 categories of adjustments, are there any categories that this company in this month needs to be made. Okay, after the adjustments, really the numbers is ready for financial statements, but again, some companies prepare the complete worksheet with 5 columns. Some companies may prefer just 3 columns where we left off in Chapter 3. Some companies may want to expand 2 other columns. So today we'll be introducing you another way to do it. But really the 3rd column has all the numbers ready for financial statements. And then last part of this chapter, we also have closing entries to make. Now closing entries is referring to temporary accounts. So as I mentioned that most of the accounts we have the final balance carried to this year's beginning balance, there are some of the accounts that we zero it out every single season. So those are the income statement accounts. Revenues, expenses always starts off 0. So when you look at each and every income statement, it only represents that particular month's net income or net loss, that particular month's profit. Okay, so revenues, expenses, dividends, these are the three accounts, the only three accounts that we close it out every single season. Okay, just so creditors and investors know, when they look at income statement, they know that this is only representing this period of time's net income. It's not an accumulated net income. Remember, accumulated is captured in equity, retained earnings. This account itself is already an accumulated earnings. But when we look at income statement, it only represents a yearly profit or a monthly profit. Those accounts, later in this chapter, you'll be learning how to zero them out. Close them out, and next year or next month, we start from zero, and then we accumulate. Okay, but the majority of the accounts are called permanent accounts. Okay, so the majority accounts, meaning all the accounts that you see on balance sheet, those will not be zeroed out as time goes by. Those are accumulated accounts, permanent accounts. Okay, only income statement accounts, revenue, expenses, and particularly dividends. So those are the only three accounts that in accounting, how we play the game is we zero them out. Whenever you see that account, you know it only represents that particular month's dividends, that particular month's revenue, that particular month's expenses. Okay, so after closing the accounts, then there's a post-closing trial balance. Some of the companies like to do this. Again, it's an internal document, not required. Depends on business. They may want to do the very last box there, the post-closing trial balance, which really is pretty simple. We'll be getting to that on Wednesday. And then next year, 2014, we'll start again from the beginning balance, which is really the ending balance from this year end. And then again, we add new transactions, post them to T accounts, summarize the information, we do adjustments, do financial statements, close the entries, start again from beginning balance. Okay, so this is a general accounting cycle. If companies do monthly statement, this cycle will happen every month. If it's a quarterly statement, every quarter. Okay, so public traded companies has to do quarterly statements, so this happens at least on a quarterly basis. Then a year basis, it happens again. Summarizes all the information that happens in the entire year. Okay, now to be more specific, again, these really I mentioned already. So beginning, we start from preceding period's balance, last period's balance. Okay, all the transactions we captured later on summarizes to balance sheet really mirrors the accounting equation. Okay, so this slide really just emphasizes the main points that I just covered. During the period, what's important is journalize the transaction as it happens. So we don't wait, we don't put off transactions. As it occurs today, we record it in journal entry. Remember, it's recorded by date, chronological record. And then as it happens, we post them to T accounts. Purpose of T accounts, using an account perspective to summarize information. When it reaches the end of the period, adjustments, the 5 categories, and then we use an adjusted amount to prepare financial statements. Then later this chapter, you'll know how to close the accounts. Specifically, we're only setting back revenues, expenses, dividends back to zero. Okay, this is just how accounting works. So some of the temporary accounts, the more narrow accounts, we just close them out on a periodic basis. Okay, but all the balance sheet accounts, none of the exception, all the balance sheet accounts are permanent accounts. We don't zero them out. Meaning that last year you see $2,000 under cash account, you will still see that $2,000 this year, and then you just add to it. We don't just set it back to zero. Okay, but revenue, expenses, dividends, just by its nature, these are part of retained earnings. So later on, we just transfer the information to retained earnings account. So that is an account that holds all the net income information. Then we just set these back to zero. Okay, worksheet again, just for summarizing purposes. Internal document, not disclosed to creditors or investors. Worksheet just for the purpose of accountants, help them to summarize information, make sure debit equal credit before doing statements. Any questions so far? is another thing. I have already posted the detailed slides with the answers on Blackboard already, and also the practice question answers. So you'll be getting practice questions back on Wednesday, but you do have the answers there on Blackboard under course documents. Okay, so you can start doing the review by downloading them. All right, in terms of time point, again, just to mention the important parts here: journalizing, posting during the period, adjusting, prepare financial statements, close accounts. These are critical parts that happens in the last part of the period. Okay, typically the last few days. We do the adjustments, prepare statements, close the accounts. Okay, but during the period, what happens on a daily basis is the regular transaction that kicks in, then you journalize it, then you post it into T accounts. So this is just in terms of the timeline, how it is being done in each and every accounting cycle. Okay, let's take a look at a worksheet. Remember that I mentioned the first 3 columns really is the same as we did last week for adjusting entries, adjustments. We're just adding 2 more columns, income statement and balance sheet, okay, on the right-hand side. So again, this internal document here, the purpose really is just to summarize information, making sure debit equal credit before preparing this set of financial statements. So that's all it is. It's an internal document. It's not disclosed to the public. Right? So some of the companies may do 3 columns. Some of the companies may do 5 columns altogether to be more complete. But really, you'll find these 2 columns, the information, exactly the same as the adjusted part, just picking the part that relates to income statement and copy it again. Picking the part that relates to balance sheet and copy it again. Okay, so let's take a look at how this works from the beginning, again, the first column. So of course, after a lot of the transaction that happens, we summarize them, we already capture them in journals, summarize them in T accounts, then it goes into trial balance. Okay, so the left-hand side, the beginning, has all the accounts which relates to the transaction that happens in a certain period of time. And of course, it has the dollar amount. Again, this is from T accounts, this summarized balance in T accounts, and we copy it to trial balance, an unadjusted trial balance sheet. Okay. So then we total the amount, make sure that this part, the unadjustments, even before adjusting entries are recorded, debits equal credits. Okay. The reason why these 2 always equal is because, remember, in accounting how it works, whenever a transaction happens, we have at least 2 accounts that is affected. Could be 3, could be 4. But debit always equal to credit. Okay. So one side of the asset is affected. It's either one side of the liability is affected or the same part asset account, the other side will be affected. Debit and credit will always equal. Okay, so the trial balance here, for each and every column, we want to make sure this part equals to each other. Okay, so this is the first column. Second, just briefly review the adjustments here. There's A all the way to H adjustments. I have a couple of entries here. So if we take a look at 2 examples, say the accounts receivables, originally we have the balance $2,200, which means later on there will be cash received $2,200. Now the adjustments here, you see $400 also on the debit side, so we will have to add this to the $2,200, because remember, asset normal balance is the left side, the plus side. If the 400 is on the right side, then we have to reduce it. Okay, but since 400 is on the left side, that means that there must have been some type of service provided. You can see the other side, the 400 is here. Service revenue provided, but not yet collected cash from customers. So this is an additional 2 accounts receivable. So you see the adjusted balance here, $2,600. Okay, so this is one example we went over last week. Another example here, an earned service revenue credit 600. So what does this mean? An earned service revenue credit means, so first of all, what is the normal balance for an earned service revenue? It is a liability account, meaning that it has the opposite direction as compared to asset. So the normal balance side will be the right-hand side, the credit side, meaning that whenever there's accumulated liability, it will be reported on the right-hand side. So this $600 means that the company now originally has $600 liability. With the adjustments, we put it under the debit side. What does that mean? Liability is being reduced, right? So $200, the unearned service revenue represents the cash you collected in advance, but you haven't provided service. And now we did provide a third of the service that's worth $200. So then at the end, we have a final adjusted balance, $400, meaning we still owe client $400 worth of service. But it's no longer $600 because we had provided part of that already. Okay, so this is another example of the adjusted trial balance after adjustments. So again, at the end, we want to make sure that the adjustment columns, these two will balance. These two would always balance. Okay, these numbers could be different because remember we're doing adjustments. It has to be different later on. But debits and credits will equal to each other. Debits and credits for each and every column will equal to each other. Okay, now if we add in income statement column, just by its name, this is the column that represents only income statement accounts. So you can probably already guess what will fall under that column, right? That would only be revenues and expenses. Okay, so when you look at an adjusted trial balance, you can just draw a line or draw an imaginary line. All the accounts that fall below this will go into income statement column as well. And it's exactly the same. Okay, we're just copying and pasting this because this is an income statement column. It just represents all the income statement categories. So all the revenues, all the expenses. So the purpose of this column is just like a draft of income statement. You see the information here, and later on you do the same thing for income statement. Okay, so above the line here, those that are not income statement categories will later on fall into the balance sheet category. Okay, those are the asset account, liability account, and stockholders' equity account. So there's one thing that you have to make sure that you know here. You can see that the last part here looks a little different from all the other columns. So earlier we were summarizing transactions, debits equal credits. Here, just because it's income statement column, very rarely would you see revenue exactly equal to expenses, right? Because remember, the whole purpose of this statement, this income statement, is to figure out net income or net loss. So this case here, you have the right-hand side, revenue 7,600, left-hand side, all the expenses 3,900. Do we have a net income or a net loss? We have a net income, right? Because revenue is more than expenses. This is pretty obvious, right? So the right-hand side is more than the left-hand side. We do have net income. Just for the purpose of bringing these two, debits equal credits up, just for the purpose of this, we put the net income amount here. Okay, so this $3,700, it's under the debit side, but really don't apply any debit credit rule to this. So the whole purpose of this is for the worksheet to make sure accountants, they do the debits and credits right. We want to make sure that each and every column we see the two numbers here exactly the same. Okay, so you do have the original revenue here, expenses here. If you find net income, put the net income next to, right below expenses, just to bring up this side so these two equal. Okay, so there's no debit credit rule here. Don't read too much into this. We're just putting net income here, and if it's net loss, then it's put under the right side. Okay, whichever side is missing amount, we just put that amount in between. Okay, so this is just one thing special about an income statement column. At the end, we don't just leave the revenues and expenses here. We still bring up the two to equal to each other. Just put net income under expenses. If it's net loss, it'll be under revenue. Just to bring up the balance, that's all it is. Okay, moving on from income statement column. Again, I just mentioned this. If you have net income, we put it under the left side. Net loss, we put it under the right side. Okay, no debits and credits rules involved here. Simply we're just making the columns equal to each other. Debit equal credit. Okay, last column, balance sheet column. Again, just by its name, so all the asset account, liability, stockholders' equity, common stock, retained earnings account, all the equity accounts will be copy and paste to balance sheet column. All these numbers really are exactly the same as adjusted trial balance. Okay, we're just partitioning into the parts that belongs to income statement and the other ones that belongs to balance sheet. But you do see at the end net income also listed here. Right. So can anybody tell me why is net income also listed there? This is a balance sheet column, so why is net income there? Well, this will go back to equity, right? Again, equity can be parsed into common stock, retained earnings. Retained earnings is the earnings kept all along the years, so the earnings will definitely incorporate this season's earnings. So the $3,700 is the new earnings made in this season. We will add to the original balance retained earnings, $3,200 there. Okay, so the $3,200 there is an old balance. Retained earnings is the only account within the entire balance sheet column that has an old balance here. Okay, all the other accounts, cash, accounts receivable, all the other accounts are the latest one. Only retained earnings waits till we summarize net income information. Then this will be added to $3,200, then minus $1,000 to become statement of retained earnings. Remember? Okay, so whenever there's net income, it adds to retained earnings. It's a plus to earnings account, so we add it under the credit side. If there's net loss, then we add it under the debit side. So this is another thing about balance sheets, since we don't have 3 columns for each and every statement, because really if you think about retained earnings, there's only 3 accounts there. There's only beginning balance of retained earnings, net income, and then dividends. And sometimes there's no dividends given out this season, then there's even no point for putting that account there. Right, so oftentimes companies' worksheet will just omit statement of retained earnings because there's only 3 accounts. But they do put net income here just to represent that this adds to retained earnings $3,200. So the $3,200 is a beginning balance. This is a new income that will add to that. There's also $1,000 that needs to be subtracted. Okay, so this is listed here just because there's no statement of retained earnings column. Okay, so we just incorporate this in balance sheet column because really this is part of retained earnings that's represented in balance sheet. Okay, if we look at it all together, all 5 columns, it looks like this. Trial balance, adjustments, adjusted trial balance, and the income statement column you see net income listed here. If net income listed here at the same time, it will also be listed under the credit side of balance sheet because it brings up retained earnings balance. Okay, this part here doesn't involve any debit credit rule. This does. Okay, net income brings up retained earnings, so it's under the credit side. Meaning that if it's net loss, then you will see the 2 amounts here. Okay, if it's net loss in this case, revenue will be lower than expenses by the definition of net loss. And you will put net loss information here. Net loss reduces retained earnings, so retained earnings normal balance is the right side. If it's being reduced, it will be posted under the left side. Okay, so this is an example for net income. You'll see both amounts here. Net loss, you'll see both amounts here. Now at the end, if you look at each and every column, debits will equal to credits. We purposely make this happen. The first 3 columns has to be equal. If it doesn't equal, that means there's some type of error that you made while you journalize it. This part here we purposely made it the same, just to put net income and net loss here. This part here we also purposely make it the same to put net income and net loss here. Okay, but the first three, when you post the final balance from T accounts, it has to equal to each other. Otherwise, you need to go back, trace all the transactions that you've recorded. Okay, any questions before we do an exercise? I know it's a little tedious, it's a little complicated, okay, but when you get to the problems and actually do a set of these, it's really not that hard to follow. Okay, really the core idea is very, very easy. The core concept here is just to capture all the business activities, figuring out the profit of the activities, then figure out overall what is the total assets that you own, what is the total liability that you owe, what is the net worth of the business, what is the new earnings that you made. Okay, that's really all it is, summarizing this entire worksheet. Okay, let's do a exercise here. We have all the accounts here. I'm going to pass around the worksheet. Take a look at A, B, C, D adjustments there. Those are the adjustments that you will need to make for adjusting entries, adjusting entry column, and adjust to trial balance. If you don't have a copy, raise your hand. Thank you. Okay, for A, B, C, D transactions, you have A here, accrued service revenue, which means, remember, accumulated service revenue, then if it's accumulated, that means you haven't actually collected the cash from customer. Okay, so this is a service revenue, and at the same time, it's an accounts receivable. B, supplies used in operations, $400. It already tells you this is the part that you used up. So meaning adjustments here, if it's something that you used up, you will have to reduce it by $400. Okay, C, to give you a hint here, C, accrued salary expense. Anything that is accrued, accumulated salary expense, and you haven't paid out the cash. So at the same time, this is a liability. D, depreciation. You know, depreciation always comes together hand in hand with accumulated depreciation. Okay, so these are the only 4 adjustments. Try to make it the adjustments amount here. If you need to journalize it first, then journalize it first. If you don't need to, you can just jot down the amount here. So this is just an in-class exercise. I'm not going to collect this back. This is for your practice purposes. Then after adjustments, try to figure out the up-to-date adjusted balance. Okay, and then if you can, try to do income statement and also balance sheet. This entire worksheet, in case you lose it, is also on Blackboard, right? Alright, let's take a look at the adjusting entries here. So before we get to do the entire worksheet, we need to understand what are the ones that need to be adjusted. So this is a problem that readily gave you a table of unadjusted balances, which really is already there in the worksheet. You just need to use that and then add or subtract some of these 4 adjusting entries that need to be made. Okay, so these are 4 adjustments here. We know the dollar amounts, so the question would be, what are the accounts that we need to use? So for accrued service revenue, this is an accumulated service revenue, meaning this is the revenue that you readily earned. You provided service or provided goods to a certain point, and when it reaches the end of the season, we want to recognize the part of revenue that we earned, even though it's not yet cash receipts. Okay, we haven't actually collected cash. This is accounts receivable. We debit accounts receivable, and then we credit service revenue for $2,600. So in your adjustments column, you'll find accounts receivable. On the debit side, put down $2,600. In the credit column, you will find $2,600 credited for service revenue. So this is A adjustments. Okay, I'm going to go over the worksheet a little bit later. I'm going to do the journal entries first. The second entry here, supplies used in operations. So meaning that $400 worth of supplies already has been used up. It's no longer there. So originally we have balanced $1,400, and now we used up $400. This turns into supplies expense. So notice as this problem is telling you the part that's used up, not the remaining balance. So last week there was a question that asked you was giving you the remaining balance, and you go back to trace back what is the part that we used up. Here is directly telling you the part that we reduced. Okay, so that will be $400. And then we reduce assets, supplies, credit, $400. So you'll find under the adjustment column, supplies being reduced, $400, supplies expense increased, $400. Okay, now tell me the accounts that we need to use for C. What do you have for debit? Salary expense, right? Here we accumulate expense, right? It's accrued because we haven't paid off the money, so the credit side would be salary payable. Good. So liability account increase is on the credit side. So you'll see salary expense debited $1,700, salary payable, the adjustments credited $1,700. Okay, what about the last one? What do we debit here? Depreciation expense, very good. And then accumulated depreciation, which again is an asset account, but it's a contra asset account. So contra asset has the opposite rule. You will be posting additional value of deduction for furniture's value or deduction for building's value under the right side. But we almost never use the left side. For the most part, accumulated depreciation, you almost always see value on the right side because it goes together with one of the asset account. They're representing reducing furniture's value or reducing building's value. So you will almost never see it, any dollar amount on the left side unless there was an accounting error that we need to adjust based on the prior transaction that happened. So you will see accumulated depreciation, $4,100, depreciation expense, $4,100. So these are the only 4 adjusting entries that need to be made based on this problem, the information given to you. So if we represent them in a worksheet, summarizing all those adjustments, just copy the dollar amount to its specific category, debit credit side, it would look like this. Okay, so you have adjustments A on accrued service revenue, accounts receivable, service revenue. You have B there representing used up supplies, $400, which we turn into supplies expense. You have C, salary payable accumulated, because employees worked for us, so their salary expense incurred already. Okay, you have D here, depreciation expense, and then accumulated depreciation up there. So each and every transaction, one on the debit side, one on the credit side. Make sure you post them to the right side. Okay, if you haven't posted them to the wrong side, then you have a double amount error effect for one side. One side will be more than the other. So at the end, total adjustments, debit credit equal to $8,800. Then the adjusted trial balance really is just adding or subtracting the adjustments. So cash account, for example, has no adjustments being made. Remember, all the adjusting entries will have nothing to do with cash because all the adjustments is tied to one of the prior transaction. Okay, so adjustments here, cash will remain the same. Accounts receivable, earlier we had 0. Now we have $2,600. Supplies will be reduced by $400, so now altogether we only have $1,000 worth of supplies. Originally it was $1,400. Okay, equipment, the same amount, just copy. Accumulated depreciation, we have $18,500, and now additional, $4,100. Okay, so you see the original balance of accumulated depreciation on the right side. Now we have an additional amount that we want to represent under this account to bring down the value of long-term asset, because we have been using long-term asset. Okay, accounts payable, same dollar amount. Salary payable, we have adjustments here. Originally was 0, so now we have $1,700 that we owe to employee. Retained earnings, same dollar amount. So retained earnings will not get updated until we do income statement. Okay, so that retained earnings there, $1,500, is not an up-to-date account. All the others are. Retained earnings is an exception here that still has the old balance because we haven't done income statement yet. Okay. Common stock, the same amount. Service revenue, we add additional $2,600. Salary expense, we add an additional $1,700. Okay, depreciation, supplies, same as adjusted amount. Okay, so at the end, you should be getting to a total debit amount, $131,500. Same for the right side. These two should equal to each other. I'll give you a minute if you need to make adjustments. And then I'll go on to the last two columns. Again, for those of you that came late, midterm will be March 4th. Okay, it will not be next Monday. I pushed it back to a week later. Midterm will be March 4th. I'll be also making an announcement, but if you see your friends that didn't come to class today, make sure to pass on the information. This weekend I will make an additional homework, just move back 2 weeks later's homework to this week. So you will have still a week of homework to do practice, but then when it reaches next week, you don't have homework that's due the following. The weekend before midterm, you don't have homework. But this week, you still have another homework. Okay, I'll be posting it later. Okay, let's move on to the remaining two columns. First one here, I just copied the adjusted trial balance from prior slide. So now we're just doing income statement column, which means we're only representing revenues and expenses here. So just copy revenue and expenses, exactly the same amount, copy to income statement column. But the last part here, remember that we have revenue here, total expenses here. Just for the purpose of bringing up debit to equal credit, we put net income here. Okay, it's obvious that revenue now exceeds expenses, so meaning the company is doing pretty well. There's net income. We already know this for a fact by comparing these two numbers. So when you know there's net income, to bring up the total debit side to equal the credit side, we just put net income information here. So in other words, when you look at a worksheet, if a company has a worksheet, when you look at a worksheet, even though you don't see the $2 amount revenues and expenses, if you see $1 amount at the end below the last row, you see it here, that basically represents net income. Okay, if you see a dollar amount here, that represents net loss. Okay, last column for balance sheet column, just copy all the asset accounts, liability account. Revenue expenses, we put it under income statement, so don't worry about revenue expenses for balance sheet. Balance sheet, just by its definition, we only have the permanent accounts, asset, liability, common stock, and also retained earnings. Okay, but again, the last part here, you do see that net income is included here because, again, we don't have statement of retained earnings column. So retained earnings balance up there, the $1,500 there is a old balance. That's the beginning balance. You need to add the new earnings, and then subtract any dividends, which in this case, we don't have any dividends given out. Okay, so really there's just the old balance of retained earnings and new net income information here. So net income adds to retained earnings. Retained earnings normal balance is the credit side, so that's why it's under the credit side. And again, summarize the information at the end. You will find total debits to equal total credits. So before adding this net income, it doesn't equal to each other, because remember that retained earnings is an old balance. So from income statement, the profit will transfer to statement of retained earnings. Statement of retained earnings will be updated, and you will have the new statement of retained earnings balance for balance sheet. So this is why this is here.
For the balance sheet, the ending, 44,100, how come it's on the credit side?
Because this is representing the net income, right? So net income increases retained earnings, and then retained earnings, the normal balance, increases on the right side.
Okay.
Remember, equity account. So if equity account expenses, dividends are sort of like exceptions. It lowers down equity amount, net worth of the business. But net income is a good thing. It increases retained earnings. We put it under the right side. Okay? All right, so this is a complete worksheet. The most thorough internal document that a company could have, 5 columns with all the information, and then really for actual statement format, these things just need to be key into the actual statement format. Okay, like income statement form has a heading, has a title, has all the information, which is exactly the same as what's here, just into the format structure, statement structure. Okay, any other questions before I move on to statements? Okay, if you understand the adjustments, you understand the adjusted trial balance, you understand what we're trying to do here, when it reaches statement, it's really easy because all the information, we're just representing it in a format that is the same for all the public traded companies. Okay. This slide, this information just summarizes that sometimes companies, if they want to do monthly statements, since it's a recurring thing that happens every single month, sometimes doing adjusting entries, they find it very tedious and complicated to do it every single ending month, to actually journalize them. So oftentimes they may just utilize this worksheet, like what we just did earlier. I ask you don't have to do the journal entries, you can just jot down the information in worksheet. So sometimes in the business they do the same thing. Sometimes accountants, they just use the worksheet to maintain monthly adjustments, and then they do all the adjusting entries before December 31st, before year end. So this happens for some of the companies. They just use this worksheet like what we just did earlier. I ask you don't have to do journal entries, you can just put down information if you could. Accountants, oftentimes, they may just use this adjustment column to keep track of some of the adjustments every single month, but they don't officially do the journal entries until year end. Okay, so that's just an additional information for you to know. Some of the companies, they do them on a monthly basis. Other companies, they may find it very tedious. They just do it all together when it reaches year end. Okay, still keep track of adjustment, just not actually journalizing them officially. They sometimes just jot it down in worksheet. Okay, so this is what this slide is trying to tell you. Worksheet, it allows business to see results before even journalizing or posting them. Okay, so for the most part, journal entries are captured already. The unadjusted trial balance has the majority of the entries. But for adjusting entries, the minor ones, oftentimes company could also accumulate them until year end to officially put them in a chronological record. Okay, but in the meantime, they do update the worksheet. All right, let's move on to statements. From worksheet, how do we do statements? Really just putting exactly the same information into a statement form, which you have been doing it since week 2 on some of the assignments, right? Assignments, typically I'll give you 1 or 2 problems that actually leads to, at the end, doing this entire financial statements. So we start from income statement, which captures revenues and expenses. Really, we're just capturing worksheet information and copy it to a statement format that has the company name, the type of the statement, the time period. If it's a monthly statement, it will be month ended, certain date. If it's a yearly statement, it will state year ended, certain date. Okay, at the end, the goal here is to get to net income and net loss. Again, profitability of the business. The profitability is the main goal for income statement. So once we have this net income information, $3,700, remember this is linked to statement of retained earnings. We want to update retained earnings account. Okay, so for statement of retained earnings, that $3,700 you will see appearing here again. This is how these two statements link together. Okay, profitability is only very narrow perspective, just revenue and expenses. Here, this is the total kept earnings from prior years. Total accumulated earnings from before. And now we add in the new earnings this year, or this month. Okay, if there's dividends given out, also subtract this. This will eat up a part of the earnings, but think of this as a gift to shareholders. So at the end, the new earnings balance after this month's operation will be $5,900. Okay, so this is the second statement. The simplest one, really, this is just capturing the changes in earnings. Okay, so now we have $5,900. This is the up-to-date retained earnings, and this will link to balance sheet. So you will see exactly the same number representing the second statement here. Okay, make sure you understand this because worksheet, it has the old balance of retained earnings. It's not up to date. All the other accounts are up to date. Worksheet, it's not up to date because the net income is here. Okay, so make sure under balance sheet, this retained earnings that you represent here will be the same retained earnings that you see in the second statement, but not in the worksheet. Okay, because the worksheet hasn't updated that information. You see net income over here. Okay, but balance sheet, you will see retained earnings up to date based on the second statement's earnings information, and then all the other accounts, assets just falls into asset category. Liability, we see it under liabilities category. And common stock, just directly copy-paste the same dollar amount. Okay, so there's probably a difference that you see from this statement compared to Chapter 2 or Chapter 3 statement. You have 2 columns in the asset category. Okay, really, this is just summarizing. This is because of the accumulated depreciation, the long-term asset accounts here. So remember that I mentioned book value of an asset will be changed whenever we depreciate assets. You see the original cost for furniture is how much? The original purchase price for furniture. $18,000, and we see accumulated depreciation $300. So meaning that right now, after this month of using this furniture asset, really the value is close to $17,700 instead of the original $18,000. Okay, we're trying to depreciate the asset, reduce and deduct the value of it, the usefulness of it. Now, what about building? Building, you see the original cost, purchase price is $48,000, and now we depreciate it by $200 here. Okay, so the current value really is no longer $48,000. We think of it as the book value of the building is $47,800. Okay, so the middle column here, the left-hand side column really is there just to do a subtotal for these assets. Okay, so these are all the 3 statements. I will leave closing entries for Wednesday. So let's just do a quick practice questions, and that'll be the end of today.